This graph is interesting. You can see how much house prices have increased relative to income since the 70s. You can also see a massive reduction in house prices following World War II. This reduction came from massive government spending on public housing and housing subsidies as a way of reigniting post-war economies. And the low relative prices that remained because of these policies remained through much of the next half of the century. But then you see a massive rollback in public spending on housing, which basically set the conditions for the massive increase in prices you can see towards the end of the graph. Since the 90s, more than 260,000 public housing units across the US were either sold to private owners or demolished. And in Britain, since 1981, nearly 3 million units of council housing have been sold off or transferred to private owners. In New York alone, between 81 and 2011, the number of rent-controlled apartments went from 285,000 to fewer than 39,000. I want to talk in this video about the housing crisis, but I want to do that while keeping in mind the concept of opportunity cost. Opportunity cost, of course, is the idea that when you spend a limited resource, potential opportunities afforded to you by alternative spending choices are lost. The idea is often applied to choices of individuals or individual businesses. For example, if you buy a donut, you not only lose a few dollars on the donut, but you also lose the opportunity in that moment of consuming some healthy oranges instead. But I think it's also interesting to apply the concept of opportunity cost to the societal level. But at the societal level, we obviously don't have one person deciding what to buy, but a collective of top shareholders who are making decisions with massive macroeconomic consequences. So obviously then a key concern in relation to opportunity costs here is what motivates these top decision makers. Like, are they more often going to choose the donuts or the oranges? Donut in the housing sector is expensive housing, and I'll explain why in a minute. And the missed opportunity is more affordable housing. And of course, all the social and civil benefits that would come with more available housing. CRE Daily is a newsletter designed for real estate investors and developers. And in its own words, it says that in 2024, while the US faced a housing shortage of 1.5 million to 7 million units, only 6,700 affordable apartments were under construction, compared to nearly 500,000 luxury units. The luxury market in the US is valued at the moment somewhere between $290 to $640 billion. In the same CRE Daily article, there were some statistics published on the number of housing developments according to market price, and they showed that the most expensive tiers of development reached well into the millions around 2020 and dipping just below the millions, while the cheapest tiers barely even were visible on the graph, numbering just in the low few thousands. This isn't only in the US, of course. In Australia, where I'm from, I've had to pay well above 30% of my income on rent. So why do our societies continually buy the societal donut and skip the healthy oranges? Basically, housing developers invest in high-end rather than low-end developments because the high-end market is where the largest profits are made. And this is due to a few reasons. There are higher profits in more expensive housing because of higher land values in wealthy neighborhoods and a higher profit margin judged necessary because of higher risk at more money being invested, and also higher price ceilings for wealthy investors. The IHRB think tank affirms that this strategy is the case in much of the housing development world. It states, the predominant business model for private sector investment in housing too often sees financial returns prioritized at all costs, often because investment managers feel subjugated to the fiduciary duty owed to shareholders, which they say leads to higher prices. A chart by Visual Capitalist shows how much house prices, again, have risen in relation to income beginning in the 1980s to today. And it also gives a clue as to how these house prices were made possible. It shows the loan rates nearly halving compared to the 80s. These loan rates have basically enabled the massive increase in prices. And this is basically what you could call the financialization of the economy. By financialization, I just mean an increase in profit making through money lending as opposed to production, distribution, or services. The mechanism of increased financialization in the housing sector has allowed for buyers to absorb higher prices because of an increased access to money. This obviously led to the 2008 crash, right? But more generally, it's led to higher prices. On top of this, in the US, again, this stat isn't really limited to the US, but represents the global trend. Over 10% of the housing stock lies vacant, much of this stock being investment property. This is common because land value generally increases over time, which is different to basically every other good that you buy, which decreases in value. And a really depressing fact around this is that despite there being 700,000 people without a home in 2024, there were 16 million vacant homes the same year. So we have a picture here of expensive housing taking up the overwhelming majority of new developments, of which a significant sum will be bought not for living in, but just for storing wealth or reselling at a profit. Or if it's lived in, it'll be, aimed to squeeze rent profits from the inhabitants. And again, all this is made possible by financialization, by massive bank lending schemes, which are designed to just suck more and more money from average family wages. The question is, what are we missing out on here? Like, going back to opportunity cost, what alternative opportunities have we missed? And what kind of future might we create if housing becomes more affordable? If there was another government push for affordable housing like after World War II, imagine the number of unhoused people who might be rehoused and the secondary benefits that would come to a community from this. Or imagine the families who could be more mobile, live closer to work, or take more career risks. These benefits are not in the immediate interests of the shareholders. For the shareholders, these societal benefits would register actually as an opportunity cost because it would mean smaller profits. The motivations of the shareholders is then at odds actually with the needs of society. And because their decisions affect all of us, their profits lead to society-wide opportunity costs. So more time and energy is directed away from abundant housing, away from transport, hospitals and schools, and towards expensive condos, more holiday homes and mansions where those shareholders and their immediate beneficiaries can park their wealth. A lot of these ideas came from Madden and Marcuse 2016 in their book In Defense of Housing, as well as The Financialization of Housing by Albers, I think published in the same year. Okay, guys, that's it from me. Hope you've enjoyed my ramblings again. It's been a pleasure. Take care. Stay safe, everyone. Cheers.